The Sensex has touched 78,000 points and the Nifty 23,700 plus points in the last few days. People are extremely excited and happy, but they're also confused. Should I book profits now? Should I take some money off the table? Will the markets crash? These are all the worries that are running in people's minds. Is that also a worry in your mind? Then this video is for you. Especially when it comes to investing in equities and equity mutual funds, getting out is as important as getting in. After all, we all cannot be like the Abhimanyu of the Mahabharata, who knew how to get into the Chakravyuh format of the battle, but didn't know how to get out and therefore was killed. So it's extremely important, even while we start our investment plan, to have a plan of how we are going to exit our investment. What is the goal we are investing towards, or what is the outcome that we are investing towards? But before we do that, I want to briefly talk about one very important aspect of investing. But first, let's look at, should we at all book profits? Let's examine those examples. One, if you're somebody who has a long-term horizon, say 5 years, 7 years, or even 10 years, then perfectly okay to continue to stay invested in the markets. Yes, of course, the market will have some volatility along the way. It may even go down from these levels, but that hardly matters. Just stay patient. As long as you invested in good diversified equity mutual fund portfolios, I'm sure the market will bounce back and give you better returns than you expected. So if you're a long-term investor, no action is the action prescribed. Second, if you're somebody who's looking at some amount of cash flow needs over the next 12 or 18 months, this may be the perfect time to take that money out of your equity portfolio and then park it in a safer place so that you can use it 12 or 18 months down the line. Third, if you're somebody who cannot go to sleep at night, fearful that this portfolio may crash one fine day, then you need to take significant amount of your profits out of the market. These are the three scenarios which we think you have to examine which scenario suits you and act accordingly. But before we do that, I want to talk about what is profit booking, especially in the mutual fund space. Let's examine that. Let's say this financial statement of Mr. Vignesh. He has invested 1 lakh on 1st January 2020. And that has an NAV of 10 rupees, so he has received 10,000 units for his investment. Let's say 3 years down the line, on 31st of December, his portfolio value has done exceedingly well and the NAV of 10 has turned to 22. So the 10,000 units is valued at that point in time as 2,20,000, giving him a profit of 1,20,000 on his investments. And on that day, Mr. Vignesh decides that he wants to take that 1,20,000 of profits out of the system. So he books a redemption. And at the same NAV of 22, 1,20,000 rupees will mean that he will have to pull out 5,455 units from the mutual fund, leaving him with a certain number of mutual funds, continuing to invest in that scheme. The reason this is important to understand is that how much ever amount of profit that is available as you keep pulling out, the mutual fund statement will continue to show a certain amount of investment that is there and the profits. So in this example, even after taking 1,20,000 of profit out, the statement on 1st January will show that the current value of the portfolio is 1 lakh and there is a profit of 54,000. This happens because in every unit that you withdraw from a mutual fund, there is an embedded portion of capital, an embedded portion of profit. So to that extent, when one desires to get a certain amount of money, then only a certain portion of that money is applicable for capital gains. This example is very, very important when one needs to understand the concept of profit booking, especially in mutual funds. How to go about the profit booking? We can do it any of the following ways. One is an asset rebalancing model. And this is the most scientific of the ways to do it. Let's say when you started investing, your portfolio was 50-50 between equity funds and debt funds as an example. And due to the bull run over the last 2 or 3 years, the portfolio of 50-50 has become 70-30. That is, the 50% that was invested in equity has moved out significantly to about 70%. Now, as part of the asset rebalancing, it will be your job to take that 20 rupees additional which is there in equity mutual funds and move it into debt, thereby making it 50-50 again. This is called a tactical asset allocation, which means you're rebalancing your portfolio in that manner. And when you do something like this, you're automatically booking some amount of profit from equity and then transferring it to debt. But not all of us have asset allocations already in place. So if you don't have an asset allocation, then you have to go through the next route. The next route is nothing but you pull out that 1,20,000, which is the exact amount of profit from the system. Now, the advantage of this is that you're not pulling out all the money out of equity. So, assuming that the bull run continues to go on, you still have money that's working for you in the equity market. All the same, you have protected a certain amount of the gains by pulling it out of equity. So, that's the second method. Third is, if you're a fearful person, like I mentioned, you're unable to sleep because you believe that the markets may crash at any point in time and your portfolio and your profits could completely vanish. If that's your fear, you should exit your entire portfolio. I wouldn't recommend it, but it's also an option to be thought about. In this case, you will have zero investments available in the equity market. All your monies and your profits are protected by moving it out into either debt or cash, as the case may be. You will also incur a reasonably large capital gain by doing this. But as I said, if you're somebody who's paranoid about markets as they are, then this is also one route that you should consider. Of the three, my choice would be the asset rebalancing model. The second option, if you don't have an asset rebalance, would be to part book profits. And like I said, the very extreme and the last option would be to exit equity market. Reason being that if you were to exit today and for some reason the bull market continues for another 6 months, 1 year, 2 years, as the case may be, then you will find re-entry very, very difficult. Which is why we never advise clients to exit completely equity markets, take some portion of the portfolio as profits. That's the best that will be happening. Some of the points to remember are very, very important. Every profit booking entails a certain amount of capital gains. So when you profit book, just make sure that the investment has suffered at least 365 days of investments. If you have not stayed invested for 365 days, then your capital gain tax rate is much higher. It's a 15% rate. So ideally, you should only book profits from funds which have already stayed invested for 365 days or more, so that your taxation is more benign. Second, do not take the money that you book profits and reinvest into a new equity fund. The purpose of pulling out profits is we believe the equity market has delivered a certain return. So it's not a bright idea to immediately go redeploy this money into another mutual fund scheme. Of course, you are at liberty to check if the other scheme is significantly undervalued and you take that call. But generally our belief is that you should keep it in a safer place, at least for a limited period of time. Choose to re-enter market in a staggered manner rather than as a lump sum. These would be some things that you would need to think about and deploy at your discretion. In conclusion, profit booking is a very customized and a person-specific activity. While a broad framework is very, very difficult to do, I think it's important to consider every individual's temperament, their need for funds and so on and so forth before choosing the best option.